The Indian currency has had a good year, unless things change dramatically in the last couple of weeks of the year. We're set to end with a near 5% appreciation for the current year. Now, the question is what lies ahead in 2018? Well, if Nomura is to be believed, it looks like good times do lie ahead for the Indian currency in terms of those who were expecting an appreciation in the currency. We're joined now by Craig Chan, Global Head of EM FX at Nomura. Craig, thanks so much for joining us. Appreciate you taking the time. I was just looking at your charts, and if I'm reading them right, correct me if I'm wrong, are you most bullish on the Indian currency among the Asian currency pack, Asian emerging currency pack?
Well, I would certainly say that on a total return basis, it is near the top performers in the Asia currency pack.
Okay. What is your view on the Indian currency right now? What are the factors at play there?
So I think there's a lot. I think firstly there is the global backdrop where we at Nomura believe we're still in a relatively growth positive inducive environment. The sweet spot of strong global growth, relatively low inflation, DM policy normalization, which is likely to be gradual. That's going to be very supportive of the India rupee into next year. But domestically, I think there's other factors as well. There's been a lot of hurdles that we've gone over the past few months. Concerns about growth not picking up. We have seen evidence that growth is accelerating again in the third quarter. There's been concerns about the current account deficit and the financing of that, and it looks like it's clearly still very heavily financed by FDI and of course portfolio flows. And I would say on the fiscal front, there was fiscal slippage concerns, but even that has somewhat ebbed. The fact that there is going to be some recapitalization of the banks, that's actually being viewed as positive. And I think the key thing is we've heard from the finance ministry that over the medium term there's still this fiscal consolidation push. So I do think that there's still a lot of positivity around India and of course the rupee at this point in time.
Would oil be the major sort of risk factor there? We've already seen a widening of the current account deficit in the current year. If oil prices were to go up even above current levels in the next year, which some people are predicting, that would be the key negative for the rupee?
I would say that looking at oil itself, if we do see higher oil prices, it will certainly be a negative. Our assumption for the full year next year is that oil will be at $65 per barrel. And the analysis that we have done on the sensitivity of the external sector to the oil price backdrop is that we will have a current account deficit of around 2% of GDP. So there will be quite a significant widening. But as I mentioned, our view on FDI remaining relatively strong should largely finance it. It won't fully finance it. So we will still be somewhat dependent on portfolio inflows. But nonetheless, I think that, given the strong growth environment that we're facing in India, also the global backdrop, which we view as still a positive one, the portfolio inflows, I think, will easily come in and will easily finance the remainder of the deficit.
It would be largely equity though, right, Craig? On the debt side, things are changing. We are starting to move into perhaps a higher interest rate cycle. So anybody, coming for sort of capital gains on the debt side would probably be disappointed.
Yeah, I think the bottom line is we'll have to see limits being increased, that's for one. And you're completely correct. I think what will be very, very crucial in the year ahead is that there is some form of credibility, inflation control coming out from RBI, which I'll be very frank, the evidence so far I've seen is that they are very aware of fiscal slippage risks. They're very aware of higher inflation risks as well. So as long as RBI policy credibility continues, I think we shouldn't see any significant shock with respect to the bond markets. On the equity front, yes, if we are looking for growth averaging 7.5% next year, which is Nomura's forecast, I believe that will be a huge impetus for capital inflows, particularly in the equity side.
Okay. Craig, one sort of slightly longer term question. I mean, at least on the real effective exchange rate indices, the Indian currency is looking overvalued. We've been saying that for a while. It doesn't necessarily mean anything on a day-to-day basis until, things change globally. Do you think the fact that we're sort of overvalued on a real basis could make the Indian rupee susceptible to sort of sharp corrections should the global environment turn negative at any point?
Yeah, so I would say one thing, and that is we have numerous models to try and measure FX valuations. And the one that we actually favor the most is the one that I would say even the RBI Governor, Urjit Patel, has mentioned before, looking at the real effective exchange rate and adjusting for productivity. And when we do that kind of calculations, what I tell you is that our valuation model, adjusting for productivity of the real effective exchange rate, shows that the currency actually, even at this point in time, is still 7% undervalued. So in our measurements of that, we don't actually think it's a big issue. What I tell you is very important as well, is that even with the valuations we have, and even if you don't believe in that model and you focus on just pure real effective exchange rate, I think we're in a situation where there's significant focus of the US Treasury on RBI's intervention. And if we're looking at, for example, year to September intervention, the amount of intervention versus nominal GDP is actually about 2.7%. And that is over that threshold of intervention, excuse me, that the US Treasury has mentioned, this 2% level. So I'd say that this is already a big issue that's probably constraining RBI from actually intervening in the markets.
I was going to ask you about that. You really do think that's a big issue? Because, I know one threshold that they talk about is intervention, but there are other sort of factors at play in that particular, judgment of whether a country is a currency manipulator or not. The most important one being, are you running large and persistent sort of trade surpluses? Surely India doesn't fall in that category at all.
Absolutely. Yeah, that's a very good point. So it looks like when we look at the next Treasury report, there could be the potential for 2 out of 3 criteria being met. So it'll be the bilateral surplus, and it'll also be the extent of intervention. But as you mentioned, the actual current account position of India is a deficit, and hence, would it ever break 3 criteria? Probably not. But I don't think that's really a good enough rationale to believe that policymakers will be completely ignorant of the pressures from the US front. I think the pressures from the US front are not so much just on the criteria itself and related to trade. I think it goes beyond trade.
All right. Craig, that gives me a segue into your view on the Chinese currency as well. Domestically, there's a lot of interest on how the Chinese currency moves vis-a-vis the dollar and how the Indian rupee moves just because of the trade linkages. What's your view on the Chinese yuan going from here into 2018?
Well, I've actually always been very cautious on renminbi. I would say that some things which are very important. You look at the overall flow dynamics in China. I think yesterday was a great example when we had the November FX reserves. The FX reserves, once you adjust for valuation effects and coupon payments, you can see that they struggle to increase. That's been the case for almost the whole of this year. We've seen some months of increase, but we've seen largely monthly falls in reserves. Now, even in a backdrop where growth is surprising people on the upside this year, a backdrop where foreign investors have been actually investing into Chinese equities and bond markets, and of course the whole mentality of the foreigners changing on renminbi, I'm actually extremely disappointed. I'm disappointed that reserves actually haven't increased a lot. And I think that the rationale for that is the local diversification. There's still a huge diversification push into foreign assets from locals. And what that tells me is that if we go into next year and there's a deleveraging push, there's growth challenges, there's a kind of risk premium rising, defaults coming through, I think that diversification from locals can accelerate. I think the investment from foreigners will become much more cautious, which only tells you one thing. Reserves probably will fall a lot more next year than they have this year, which means that renminbi, in my view, over the medium term, will continue to depreciate.
So then the Indian currency would appreciate perhaps the next year, going by your forecast, and the renminbi would probably depreciate. Can you give me targets? I didn't ask you for a target on the rupee as well. Do you have targets on the rupee for 2018? And if you can share the renminbi target as well?
Absolutely. So we're looking for relatively strong performance in the India rupee. We're looking at dollar INR at 63 by the middle of next year. So it gives you pretty good total returns, just around 4.5%. By the end of 2018, we're looking at 63.50. But on a total return basis, it's still very attractive. On renminbi, we're actually looking for something not that significant, more or less in line with the forward market, around 680 by the end of next year. But I would just say that the risks, in my view, are actually to the top side.